Okay, good morning, all of you. So, I am sharing with you a video on CFA Level 3 Portfolio Management for Institutional Investors, reading number 33. And this video is in a portion of that reading. The portion is new to 2020 curriculum, 2021 also, because 20 and 21 are same this time. It was never there till 2019. So, I believe it's very important. And it's very conceptual and it's highly likely to be tested in the exam, although in CFA examinations we do not game the examination, but still there's a high chance. So please focus on this. This portion is, as you can see on the screen, section 7.9, banks and insurers, balance sheet management and investment considerations, which means what are the special considerations as far as balance sheet management and management of the investment portfolio is concerned for banks and insurance companies. This is what we are discussing. Okay. How come banks and insurance companies are different from other types of institutions? As in, you have pension funds, you have sovereign wealth funds, you have foundations, endowments, but banks and insurance companies are totally different. Why? Because for the banks and insurance companies, there's something called trust. All those who have made deposits in a bank, they believe that the bank will repay them. Whenever they go to the bank to take their deposit back, they will be able to get it. All those people who have purchased insurance policy, they know that God forbids, but if something happens and they incur a loss on the insured event, insurance company will pay them their claims. All those people who have hedged themselves by entering into OTC contracts with banks and insurance companies, they know that they will be paid in case the contracts move in their favor. All the debt providers of banks and insurance companies, they know that banks and insurance companies will pay them as and when they fall due. It is because of this assurance that banks and insurance companies are thriving. If there is an iota of doubt that a particular bank will not be able to repay its deposit holders, there will be a run on the banking system. Not only that bank, but a systemic risk, a collapse in the system. It has happened many a times globally. In India, it recently happened in the case of Yes Bank. So, the contractual claims that banks and insurance companies have, plus the fact that those claims are measurable using probability, it requires that we have a liability-driven approach to management of investment portfolio of banks and insurance companies, LDI. Liability-driven investing approach, okay, LDI approach is supposed to be there, okay, liability-driven investment approach, LDI. So that is what is different. So that was our first target to understand. So in banks and insurance companies, you don't apply the asset-only approach, you apply the liability-driven investing approach. So when you revise it, you have to remember why liability-driven. Because the nature of the liabilities, the deposits, the policy claims, the derivatives, the debt holders, they are contractually fixed and they are measurable to some extent. And that calls for managing the assets in such a manner that the liabilities can be paid, because if there is a doubt that the liabilities cannot be paid, the entire system will collapse. So liability driven investing is the first message. Okay, may I make notes side by side? So the first point, the first focus, point number 1 is liability driven investing for banks and insurance companies. So I will share a PPT along with my video so that you can go through it. But I will not dictate at length because it will waste a lot of time. Although in my usual class, I summarize and dictate whatever I have discussed, but in this class I will not. I have prepared a PPT, you can see it later on, and people who have studied with me, they know that I never look at the PPT and teach. That's not my style. Okay, because that means I am following somebody or some text which I can never do. So I teach in a very open manner, okay, because the stuff is there in my head. It comes out best when I give myself the possibility of speaking out my heart and mind. Okay, so that's what I'm doing. So the first point is LDI for banks and insurance companies. Okay, now let's move ahead. the institute has, the author has basically divided the discussion into 4 parts. Okay, the discussion is divided into 4 parts. In the first part, they discuss that the change in the value of equity, the market value of equity, is equal to the change in the market value of asset minus the change in the market value of liability. Obvious. If you look at the balance sheet, so on the balance sheet you have the assets financed with equity and liability. So obviously equity is equal to A minus L, and therefore delta E is equal to delta A minus delta L. Just because we write delta E equal to delta A minus delta L, nobody should take it as heavy. It's easy, no? The change in the value of equity is equal to the change in the value of asset minus the change in the value of liability. Okay. They have also said, okay, I'll just show you so that it's easier for you to relate. If you look at this equation over here, this equation, okay, just one second. Yeah, equation number 4, can you see on the board? Equation number 4. It may seem complicated. It's saying that the proportionate or the percentage change in equity is equal to the percentage change in asset into asset by equity minus the percentage change in liability into liability by equity. Okay, let me write that for you. So we may write the percentage change in equity is equal to the percentage change in asset into the equity multiplier, okay, minus the percentage change in liability into the debt equity ratio. Okay, so this is one equation that they've given. Now what is the purpose of giving this equation? I am putting it in a box. Whichever equation I put it in a box, that means you are supposed to know it. They are trying to say that, look, what percentage will equity change? That will depend upon what percentage asset will change, scaled by the equity multiplier. Okay, equity multiplier, you know, is 1 plus debt equity ratio minus the percentage change in liability scaled by the debt equity ratio. L by E is debt equity ratio. Okay, for instance, for example, suppose asset goes up by 5%, liability goes up by 2%, asset by equity is 4 times, therefore liability by equity is 3 times. So what will be the percentage change in equity? Percentage change in equity will be equal to 5 multiplied by 4 minus 2 multiplied by 3. You can understand, it's all the scaling effect, the amplifying effect of leverage. So what do we get? 5 into 4, 20%, minus 2 into 3, 6%, equal to what? 14%. Can you see that? So 14% is the change in equity, percentage change in equity. Okay, if assets go up by 5%, liability go up by 2%, obviously equity will gain, no? Because asset is going up more, liability is going up less, so equity is gaining. But it's amplified because of leverage. Now I'm just increasing the leverage to 10 times. So same data, asset is going up by 5%, liability is going up by 2%, and suppose the leverage that the bank has is 10 times, therefore debt equity ratio is 9 times. And this time look at the massive effect on the equity. It is 5 multiplied by 10 minus 2 multiplied by 9. So we have 50 minus 18. That comes to 32%. Can you see this? The effect of leverage. So right from level 1 or even in your basic financial management lessons, you know that leverage is an amplifier. It amplifies the financial consequences. Here you see that bank is enjoying. Why? Because assets are going up by 5% while liability is going up by 2%. So obviously equity will go up, but not by 3%. By how much percent? That depends upon what is the leverage used by the bank. That depends on the leverage used by the bank. I've given 2 examples over here. In case you want to take a pick of these examples, because the numbers are very strong. See, when you look at something with symbols, it's intimidating. But when you look at the same thing with numbers, it's superb. In fact, you try it your own self. You take some other figures and you find out the percentages in equity. There'll be a spirit of rhythm running in your body. Okay, because that time you are commanding, you're not following anybody. Right now you are following me. Let me take the other way around. Suppose assets fall by 5%, equity falls by 2%. You can understand. Asset falls by 5%, liability falls by 2%, then equity will fall, but the effect will be magnified depending upon the leverage. So I take the leverage A by E to be 10 times, therefore L by E is what? 9 times. So we are going to get 32% fall. Let's see. Percentage change in equity is equal to 5 into 10 minus 2 into 9. That's 50 minus 18 equal to 32% fall. So it might be a very simple thing, but the whole point is your ability to grasp it with ease. So how do I grasp it? I'm showing you. I imagine the balance sheet and I feel that asset is going up by 5%. Okay. And I have to find out the effect on equity. So asset by equity is how many times? 10 times. So I understand the effect will be 50%. Okay, correct? Then I look at the liability and I say liability is going up by 2%. So liability is going up by 2% and liability to equity is 9 times. So the effect would be what? 18%. Correct? So if asset goes up, equity will go up by 50%. If liability goes up, equity will come down by 18%. So the net effect is 32%. If it has become natural for you, you have gained. And if it is still a formula, this illogical, stupid formula. I say stupid because I hate formulas. I don't like that students adhere to formulas. I like that people just speak it out with numbers and feel it in their body as to what's happening. So the whole equation is saying that the percentage change in equity, the volatility of equity, depends upon the volatility of asset, depends upon the volatility of liability, and it depends upon the leverage used by the bank. Let me summarize this. So second point was volatility of equity. Volatility of equity is a function of volatility of assets, volatility of liability, and upon the asset by equity ratio. Of course, if the assets and liabilities, they have a relation to each other, correlation, it will also depend upon correlation. We can also put it over there, but I have not yet brought it into my model. Okay, sigma A, sigma L, A by E and R. In fact, if we do not discuss further, but if focus on it, so the top management wants equity to be less volatile. The top management wants equity to be less volatile. What should be done? Volatility of assets and liabilities should be pulled down. So you should have assets and liabilities which are less sensitive to all the risk factors. How do you do it? We'll discuss. The bank should use less financial leverage. They should use less debt. Okay. And if assets and liabilities are correlated, which means that over here, when assets goes up by 5%, liability also goes up by 5%. Suppose when asset goes up by 5%, liability also goes up by 5%. The effect of equity on equity will not be zero, but it will be nullified to a significant extent. So if you can ensure that your assets are related to liabilities, okay, such that both of them go up or both of them come down simultaneously, there's a correlation. In that case, the effect on this will be cancelled by this, the effect on this cancelled by this, and equity will be more stable. So even though I have not used a lot of equations, but if you can understand this part, this is the part of the entire reading. This is the entire part, the section that we are doing. So the volatility of equity depends upon the volatility of asset, the volatility of liability. Okay, it depends upon the asset equity ratio, and it depends upon correlation between them. And if you focus on correlation, we got to manage our assets in such a manner that they are related to the characteristics of the liabilities. So the liabilities are floating, so the asset should be floating. Liabilities are long term, asset should be long term. Liabilities are short term, asset should be short term. You understanding? Liabilities are exposed to some prepayment risk, as in the bank has issued some callable bonds, okay, and the bank has issued some puttable bonds, and those put options can be exercised. Bondholders can come and ask for the money. So the asset should also have such option feature. Okay, optionality, convexity, duration, okay, credit risk, all should match. If you are matching them, then the correlation becomes high, and if the correlation becomes high, in that case, obviously it's good. For example, there's an insurance company, and that insurance company has a lot of policy claims on catastrophic on catastrophic events, has an insurance policies written on a lot of catastrophic events on the liability side. So on the asset side, the insurance company may enter into some reinsurance agreement, or the insurance company can buy some catastrophic bonds which pay it when the catastrophe occurs. So you are trying to relate the nature of the assets with the nature of your liabilities. That will ensure the correlation is high and equity doesn't feel too much of jitteriness as a result of the movement of assets and liabilities. Okay, so you see something, I am not trying to focus on the maths, I am trying to focus on the conclusions. Okay, this is very, very important, this part. Equity volatility depends upon all this. Correct? Okay. Now, let's move to point number 3. This was point number 2. The first point was LDI. The second point was, sir, the volatility of equity depends upon 4 things: the volatility of assets, volatility of liabilities, correlation, and it depends upon the leverage used by the bank. Okay, these 4 things you can easily remember. In fact, you don't need equations to remember this. Now, there are 2 equations that the institute has used. One equation is DE equal to DA into A by E minus DL into L by E. Now, I would have loved if this would have been the equation. D equal to DA into A by E minus DL into L by E. But separately, it's written into delta I by delta Y. Please copy it. Duration of equity, that means the percentage change in equity for a 1% change in interest rate, is equal to duration of assets. This is modified duration. All these durations are modified duration into A by E minus DL into L by E into delta I by delta Y. Now, what are we discussing? We are discussing that the balance sheet of a bank, I'm saying bank, okay? Of course, I also mean insurance company. The balance sheet of a bank is exposed to a number of risk factors, out of which interest rate is a prominent factor. The balance sheet of a bank, when I say balance sheet, it's the economic balance sheet, not the accounting IFRS US GAAP. The balance sheet of a bank is exposed to a number of risk factors, interest rate being the most prominent. Let us for a moment measure interest rate risk via MD. We know it is a great limitation because MD only captures the sensitivity for a small parallel shift in the yield curve. Okay, so for a large shift, we used to talk about convexity, and for a non-parallel shift, we used to talk about KRD. Plus, the assets and liabilities may also have some embedded option risk. Okay, so I'm not going into all that. I'm saying that let's start with the basics, that interest rate is captured by MD. So what do we have? The duration of equity is equal to the duration of asset into the equity multiplier, the same thing we were doing above, minus duration of liability into debt equity ratio. You can relate this equation to the above equation. Equation number 2 there was, into delta I by delta Y. Where does it come from? Now here delta Y is the change in asset yield, and delta I is the change in liability yield. So they have tried to be more realistic and tried to say that asset yield and liability yield does not change by the same amount. Asset yield and liability yield does not change by the same amount. Okay, so delta I by delta Y is showing you the fact that there's an unequal change in the yield on asset and liability. Normally, assets yields are higher, liability yields are lower, and therefore the change in the liability yield is lower, the change in the asset yield is higher. So delta I by delta Y in most of the numbers taken by them is around 0.9, 0.8. That means liability yield is changing only by 80% of the change in the asset yield, or liability yield is changing only by 90% of the change in asset yield. Okay, so this is the equation. Please try to make it normal. Okay, now what does this equation show? We'll talk later. First, we try to take some practical numbers to explain what is happening over here. So let me explain that. Okay, suppose this is the balance sheet. Assets $500 billion, liability $400 billion, equity $100 billion. Okay, 500, 500, perfect. Duration of assets, DA, is equal to 7. Very volatile. So if the asset yield changes by 1%, then the assets will fall by 7% in the opposite direction, ignoring convexity. You know the basics. The duration of liability is, suppose, 5. So if liability yield changes by 1%, liability value will change by 5% in the opposite direction, ignoring convexity. So what is the duration of equity? Now, if you look at it, this is 7, but 500 out of 100 is 5 times. That means the effect is going to be 35%. I'm trying to do without formula. This is 5% sensitivity, but the liability by equity is 4 times. So the effect becomes what? 20%. So you can see that 35% minus 20%, which is 15%, is the duration of equity. Can you see this? I've tried to do it without formula. So the duration of asset is 7, but asset equity is 5 times, so it's 35%. Duration of liability is what? 5, but liability by equity is 4 times, so it's amplified 4 times 20%. So in that case, 35% minus 20%. Okay. If we ignore the delta I by delta y, so it's 35 minus 20 is equal to what? 15%. But if I take delta I by delta y to be 0.9 only, so in that case, this effect is actually 18%, because 20 into 0.9, 18%. So 35 minus 18, it's 17% answer. Formula: duration of equity is equal to duration of asset 7 into asset by equity 5 minus duration of liability 5 into liability by equity 4 into delta I by delta y 0.9. So we get 35 minus 18 is equal to what? 17%. So very high duration of equity. If I was the team, I was one of the board of directors of the bank, the top management, then I would have been afraid of interest rate rising, because if interest rate rises, equity will fall by 17%. If interest rate rises by 1%, asset will fall by 7%. The effect is 35% down, but liability will fall by 20%. Okay, such that because of the difference in the change in yield on asset and liability, effect is 18. 17% equity will fall. 17% equity will fall. Are you understanding? 17% equity will fall. Okay, so I'm really afraid. So I want to reduce this. How to reduce this? This is the crux. Since assets are greater than liability, therefore, you got to ensure duration of asset is less than the duration of liability. See, equity is going to bear the brunt of assets and liabilities. Assets amount is bigger, liability amount is smaller. So duration of liability should be bigger and duration of asset should be smaller. I am surprised that in the text they have not written this clearly. They have always tried to say DA should be equal to DL. Even if DA is equal to DL, still asset will be dominating because the asset amount is higher. Are you understanding? I am trying to show you. Suppose, once again, balance sheet, assets 500, liabilities 400, equity 100. Duration of asset 7, duration of liability 7. Correct? So do you think duration of equity will be 0? If DA equal to DL, is D equal to 0? Wrong, it is not, because the asset by equity ratio over here is 5. So the effect is 35%. The liability by equity ratio over here is 4. So the effect is 28%. Okay, for a moment let's leave delta I by delta y. Let's assume that both the yields will change by the same amount. So you find that duration of equity is equal to your 7 duration of assets into 5 minus 7 duration of liability into 4, which is 35 minus 28 is equal to what? 7%. So personally, when the author has written that a bank should try to match the duration of asset with the duration of liability, I don't think it's correct. if the bank really wants to immunize its equity from small changes in interest rate, if the bank really wants to immunize its equity, duration of liability should be higher than duration of assets, should be higher. Okay, basically the ratio of the duration of liability to duration of asset should be 5:4 in our example. But I will not dictate this portion, nor will I write it anywhere, because this is not something written by the author. And when we prepare the CFA examination, we always prepare author-wise. So according to the author, he is trying to say that usually the yield curve is upward sloping. Right now there's an exception, okay, because we are in a world where yields have touched rock bottom 0%, okay, and the yield curve is flattish. I am saying normally the yield curve is upward sloping. So the tendency is to borrow short term and to invest long term. So here we have the assets, here we have the liability. So you are borrowing short term, you are investing long term, so your duration of liability is low. Duration of asset is what? High. This is what everybody is doing. ILFS did the same in India. Okay, that's why it collapsed. It issued a lot of commercial paper, and with that funds, it gave long-term loans and long-term exposures. That's typical collapse situation, because number one, the liabilities are low. Number two, duration of liability is low. Number two, assets are bigger than liabilities, and duration of asset is bigger. So the change in the asset will always dominate the change in liability. So whenever interest rate rises, assets will fall, liabilities will fall slightly, equity will fall. Okay? Yes, of course, if you believe that interest rates are going to fall, it's a good strategy, keeping DA more than DL. But then who knows what's going to happen to interest rate in the future? If that would have been the situation, it would have been so easy for banks and insurance companies to mint money and to create shareholders' wealth. So nobody knows this. So it's better that you match your duration of asset with the duration of liability. Are you understanding? So once again, this equation, So this equation, DE equal to DA into A by E minus DL into L by E into delta I by delta Y is very, very important, and this is easy. What was our earlier equation? Our earlier equation was delta E by E, that is the percentage change in equity, is equal to the percentage change in assets into equity multiplier minus the percentage change in liability into liability by equity. This was the first equation. And the second equation is this. This is focusing on interest rate risk captured by MD. If you are learning with numbers, you will not have to learn the formula. But if you are trying to see how is it derived, I can show it to you easily. How is it derived? But that would be a complete time wastage. For the sake that people don't judge my fluency or eagerness of sharing how is this equation derived, I'm just showing you what's happening. Change in asset is equal to duration of asset into delta Y. Correct? Change in liability is equal to modified duration of liability into delta I. Change in the value of equity is equal to duration of equity into delta what? That's the confusion. Because equity, which yield should we take? So suppose we take the asset yield. Suppose. So your equation was change in equity is equal to change in asset minus the change in liability. So if I am putting the figures, DE into E into delta Y is equal to DA into A into delta Y minus DL into L into delta I. And now I keep DE on the left hand side and send everything on the right hand side. I get DA into A by E minus DL into L by E into delta I by delta Y. Okay, so the derivation is rock easy. It's very, very easy. They have done some stupid algebra to explain how is it derived. This is so easy to understand. And I never wanted to focus on this because you're not getting marks for derivation. You're getting marks for perhaps the equation, and more important than the equation, okay, more important than the equation was, just one second, was this part. The risk of equity depends upon the risk of asset, the risk of liability, the correlation, and the equity multiplier. Okay, one more way of remembering this is that if a portfolio comprises of two stocks, X and Y, what do we say? The risk of the portfolio depends upon the risk of X, the risk of Y, and correlation, and the weights, correct? WA, WB, WX, WY, normal portfolio management, same stuff. The risk of equity depends upon the risk of asset, the risk of liability, the correlation, and the asset equity ratio. Are you okay? I think we'll now come to an example, okay, before we further discuss anything. So there is an example given over here. So it's a lengthy write-up. Okay, now you can see graphs over here. Okay, so I will also attach an Excel sheet, a spreadsheet, along with this video of mine where I have made this entire thing on Excel. What is this graph showing? This is showing that duration of shareholders equity DE as a function of DA, DL, and the delta I by delta Y. So at various degrees of leverage, it is showing us over here equity by asset is 20%. So asset by equity is 5 times. And in the next graph, I think another graph is there. Over here, equity by asset is 10%. So asset by equity is 10 times. Okay, so this is what the graph is showing. Okay, the graph is of no use at all. I may record a separate video, maybe the second version, to just show you the graph, because some people, they get satisfied only when they can derive the equation, when they can look at the graph. But I have done it all on the spreadsheet. Okay, basically on this graph, this diagonal part, okay, the diagonal part, I'm not able to mark it. Let me see if I can show it to you. Just one second. Yeah, no, it won't come. Okay, I'll show you the graph via the Excel sheet only. Let me proceed ahead right now. Yeah, let's come to this example, because the example is required for your success in the exam. So this example number 7. Mega World Bank Corp has an equity capital ratio for financial asset of 9%. Equity capital ratio of 9%. Why are they saying financial assets? Because in the entire discussion, they're not talking about the operating assets of the bank, that is the building and all that stuff. Okay, they talk about the financial assets. So equity capital ratio of 9%. So if equity capital ratio is 9%, that means equity by asset is 9%. So what is asset by equity? 1 by 0.09, 11.11 times. 1 by 0.09, 11.11 times. Are you okay? Equity by asset is 0.09. So asset by equity is 1 by 0.09, 11.11 times. Those who are doing with me verbally. The modified duration of asset is 2. So the effect is 11.11 into 2, 22.22. And liabilities is 1.5. So since our asset by equity is 11.11, your liability by equity is 10.11. 10.11. So 10.11 into 1.5, correct? 10.11 into 1.5. Are you understanding? Overall, small changes in yield on liability is expected to move by 85 basis point for 100 basis point of change in the yield on asset. So delta I by delta Y is 0.85. Delta I by delta Y is 0.85. Now if I do it directly on the calculator, okay, because that's how I like these stuffs. Just one second. Yes, here I have the calculator. Let's hope it works. because in this lockdown it has been difficult to keep pace with everything. So here we have the calculator, and on the calculator let's use it. So what did we have? The equity to asset ratio was 0.09. So asset by equity is 11.11 and the duration of asset was 2. So we have 11.11 into 2 equal to 22.22 STO1. Now liability duration was 1.5, and since asset by equity was 11.11, liability by equity is what? 10.11, sorry, is 10.11. So we have 1.5 into 10.11 into the delta I by delta y was 0.85 into 0.85 is equal to 12.89 STO2. So we have RCL1 minus RCL2 is equal to 9.33. Obviously they must have asked this. Okay, 9.33. Let's see. Just 1 second. So the question asked by them is, compute the modified duration of bank's equity capital. The answer is 9.33. 9.33. And if somebody wanted to know, sir, you just show it in a very slow manner, as if we are giving a AM exam. So duration of equity is duration of asset into A by E minus duration of liability into L by E into delta I by delta Y. So this becomes 2 into 11.11 minus 1.5 into 10.11 into 0.85. In case somebody doesn't follow, where did 11.11 come from? If equity by asset is 9%, therefore asset by equity is 1 by 0.09, 11.11. And obviously you know that debt equity ratio or liability to equity is asset by equity minus 1 is equal to 10.11. So that's the first part. So the bank is really doing wrong. It's keeping duration of assets higher than duration of liability, and that's why equity is really risky. Okay, it's duration the answer. What was the answer we got? Just 1 second. The answer we got was 9.33%. Okay. Now let's read the next question. The next question is question number 2. What would be the impact on the value of shareholders' capital of a 50 basis point rise in the level of yield? If yield goes up by 50 basis point, obviously equity will fall by 9.33 into 0.5. That's basic level 1. Because if duration is 9.33, that means if interest rate goes up by 1%, something falls by 9.33%. So if interest rate goes up by 0.5%, something will fall by that into 0.5. So 9.33 times 0.5. Okay, 9.33 times 0.5 into 0.5 is equal to 4.66% fall. 4.66% fall. Okay, sure, perfect. Now, question number 3. Management is considering issuing common stock. Very good. They are decreasing the leverage. Leverage is very high, 11.11 times. So issuing common stock, comma, selling investment portfolio assets, reducing assets, and paying off liabilities. So they are shrinking the balance sheet, raising equity, also selling off assets and repaying liabilities. So leverage will come down in order to achieve an equity capitalization ratio of 10%. So if equity capitalization ratio is 10%, then the asset to equity is 1 by 0.1 10 times. Instead of 11.11, it's 10 times. And liability to equity is 9 times, correct? Assuming no change in the duration of assets and liabilities, and assuming no change in the sensitivity of liability yield to asset yield, what is the resulting modified duration of assets? Now the figures are very easy over here. 2 into 10, 2 was the duration of assets, into 10 times 20, minus 1.5 into 9 into 0.85. Okay, let's do it. Sorry. Yeah. So I'm doing it again. We have duration of assets 2 multiplied by 10. Sorry. 2 multiplied by 10, 20 minus bracket open 1.5, which is DL, multiplied by 9. 9 is okay with you? Asset by equity is 10. So liability by equity is 9 into 0.85. Bracket close equal to 8.53. We've got 8.53. Let me check if I have not committed any mistake. Sorry. 8.53. Is it? Yeah, 8.53. Okay, 8.53. Fourth question. Using the facts in question number 3, but assuming the bank rebalances its investment portfolio to achieve a modified asset duration of 1.75. So the bank has also done something. It has reduced the asset duration to 1.75. What must it have done? It has liquidated the long-term assets and put the funds in short-term assets. Liquidated long-term assets, put the fund in short-term assets, cash in hand, reserves with banks, okay, and so on. What happens to the duration of bank's equity capital? So this time we have 1.75 multiplied by 10, which is 17.5. Okay, I'm just doing it again. Sorry. Yeah. So we are doing it again. 1.75 multiplied by 10 minus bracket open. What was the duration of liability? 1.5. So 1.5 into 9, I hope you remember, into 0.85 equal to 6.03. So 6.03 is the new duration of equity. So duration of equity was 9.33 when the sum started. Look at this, a very important question from the theory point of view. In order to reduce the duration of equity, number one, the bank reduced its leverage. It increased its equity capital. Right now in India, there is a talk about recapitalization of PSU banks, because the PSU banks, they are really bleeding, and more so because of the moratorium and because of other credit defaults which may arise as a result of COVID-19. What will happen is that if really their capital gets hit, so in that case the equity capital may go below the minimum Basel requirements. So accordingly they talk about the fact that the Indian government will take a decision to recapitalize the PSUs, the State Bank of India, the PNB, the Bank of Baroda, and all that. So number one, they're increasing the equity capital, reducing the financial leverage, and number two, at the same time, they are reducing the duration of assets. That means focusing on short-term assets, not trying to ride the yield curve, ki borrow short-term and invest long-term. No, that will not. That's a very risky thing. So they reduce the duration of assets to 1.75 from 2. They decrease their leverage A by E from 11.11 to 10. And the combination of these two reduced their duration of equity from 9.33 to 6.03. Okay, so that is what they are trying to teach over here. Okay, just one second. So the fourth part, let's summarize up till now what we have done. Number one was LDI. Banks and insurance companies have contractual liabilities. Liability towards deposit providers, liability towards policy holders, liability towards OTC derivatives, liability towards debt holders. They got to meet the liability. In fact, meeting is a different thing. They got to run in such a manner that everybody is assured that the liability would be met. Only then people will rely on them. Only then they will be profitable. Okay. So therefore, assets of the banks got to be managed in such a manner that the liabilities are met. That's called LDI. LDI. Even if you say this, you understand I'm talking about correlation. That there's a correlation between the assets and the liabilities such that there's a matching between the two. Okay, you cannot manage the investment portfolio of banks and insurance company in isolation. Also, one important point. We were talking about assets and liability management. Obviously, if you are the portfolio manager, you are only in charge of a small portion of balance sheet. That is the portfolio of assets. But what about advances? What about other liabilities, capital structure? Everything is not under your control. So this portion is also trying to say that the motive of the banks to focus on assuring that their liability shall be met, this cannot be the onus of the portfolio manager alone. So the bank, as in the top management, will manage their business complex, okay, the business mix in such a manner that DA is close to DL, and if they feel that managing the assets and liabilities from a business decision making is very, very difficult, it's not possible, they will ask the portfolio manager to manage his investment portfolio to make DA closer to DL. Very, very important. Let me repeat this. We want to ensure that DA is close to DL. Okay, so that DE is low. DA close to DL, so that DE is low. How do we make DA close to DL? DA is very high, DL is very low. How do we make this happen? Two types of decisions. Number one, business. Number two, portfolio. Business decisions has to be taken by the bank, by the CEO, by the CFO, by the board of directors. They will have to decide. But then business assets and liabilities are difficult to play with. For example, a bank has given a long-term loan. How can it take back the loan? It is not possible to take back. No? So business assets and liabilities are rigid. They are less flexible. In fact, liabilities are very, very rigid. Assets are still flexible. So business decisions are rigid. You cannot make DA equal to DL by way of business decisions. Therefore, you will turn towards your portfolio manager and you will tell him that, look, we are wanting you to focus on short-term assets. You please decrease the duration of your asset portfolio. Very, very important lesson, this one. Okay, I'll just write it down. Number one, LDI. Number two, volatility of equity is a function of volatility of asset, volatility of liability, correlation, and your leverage, that is asset by equity ratio. The equation for this was delta E by E equal to delta A by A into A by E minus delta L by L into L by E. Number three, the third equation was focusing on interest rate risk. DE, duration of equity, the sensitivity of equity for a 1% change in interest rate, is equal to DA into A by E minus DL into L by E into delta I by delta Y, since they are assuming that liability yield will not change by the same amount as the asset yield. So this is the three portion that we have done. I have also said something. What? Number 4. If DA greater than DL, how do we bring DA close to DL? How do we bring DA close to DL? So the first answer is business decision making, and the second answer is investment portfolio management. Apply your brains over here, please. Business decision making. Okay, so we'll have to somehow ensure that our assets are going into short term. For example, if there are long term loans given and all, is it possible to enter into a swap? Wherein we receive floating and pay fixed. Yes, it's possible. So we have fixed rate loans given, we enter into a swap, interest rate swap, wherein we are receiving floating and paying fixed. So obviously fixed gone, the duration of assets comes down. So you can enter into OTC derivatives, you can enter into T-bond futures for the purpose of reducing the duration of what? Assets. Okay, or if it is possible to call back the loans given, then call back the loans given and put them into short-term securities. Of course the yield will be low, but still you will be safer. Okay. So business decisions and investment portfolio management is like the portfolio manager shall be told, you please ensure that your DA, the duration of your assets in your portfolio is low. So overall it will help the bank. Now the fifth part of the discussion is very easy. They are trying to say that interest rate risk captured by MD does not capture everything. Obviously, it does not capture other components of interest rate risk, the non-parallel shift in the yield curve, the convexity, okay, the optionality and so on. Plus, what about other risk, currency risk, credit risk? Okay, they are not captured by this at all. So therefore, we'll look at sigma E, okay, or I should say sigma square or sigma E equal to root over A by E the whole square into the variance of, this is also truly speaking this, okay, sigma delta E by E equal to A by E the whole square into variance of asset plus L by E the whole square into variance of liability minus 2 into correlation into SD of the proportionate change in asset into SD of the proportionate change in liability. Now it would be unfortunate if this equation is intimidating for some people. This should not be at all, not at all. If we have, what to say, I should say alpha is equal to AX minus BY, then variance of alpha is equal to A square variance of X plus B square variance of Y minus 2 into correlation into 2 into correlation into, sorry, or should I write 2 into A into B into correlation into sigma X into sigma Y. This is a normal equation, the one that we use in portfolio management also, Markowitz formula. It's coming from there, so don't too much focus on this. A good student will in fact go to equation number 1 and say that equation number 2 and say that, sir, what you have written over here, this is the same thing that you have written over here. Perfect. That's what I have written. Look at point number 2 and point number 5. Point number 5 is a mathematization of the feeling, okay, communicated in point number 2. Can you see this? A by E the whole square is variance of asset plus L by E the whole square, variance of liability minus 2 into correlation into this. So how do you reduce this? If you want to reduce this, you got to reduce the leverage, you got to reduce asset volatility, you got to reduce liability volatility, you got to increase the correlation. So reduce the asset volatility. Now we could have said it over here only. Look at this equation, point number 2, that's much easier. You want to reduce sigma E. So you got to reduce sigma A, got to reduce sigma L, got to increase the correlation and got to reduce the leverage. That we understood. So many a times when big equations come, people do not remember the simplicity, the fact that they know the stuff of this. So the equation is very easy and the underlying stuff is very easy. So how do we reduce financial leverage? Issue equity. Okay, raise equity capital. So how do we reduce the riskiness of asset? Obviously, improve the credit quality of assets. Invest in government security instead of corporate securities. Okay. How do we reduce the liabilities SD? A bit difficult, but still go for liabilities which don't have too much of option, embedded feature and all that. It will help you a lot. Okay. How do we increase the correlation? Look at the nature of liabilities. Try to make assets which are similar to the liabilities. Okay. If you have liabilities in which you have to pay variable, you got to ensure that the assets are also floating, okay, variable types. So try to match everything on the liability side, the asset side, and thereby the correlation goes up. Okay, let's look at the question. I think once again the question will help. Just one second. Once again they have shown by diagram, look at this diagram, that if the correlation goes on increasing -1 to -0.75, -0.5, -0.25, as the correlation goes on increasing, risk goes on decreasing. But why so many graphs? Because these graphs are at different levels of leverage. The thick graph right at the top is at the highest level of A by E. Then A by E goes down, goes down, goes down. I will once again attach an Excel sheet of this. Don't worry. I'll attach an Excel sheet for those of you who really want to run their fingers. They can run their fingers on the spreadsheet. Because if I show the spreadsheet right now, the entire rhythm and the benefit cost ratio will come down, the profitability index. You got to ensure that you are focusing on the crux. So we got to increase the correlation between the assets and liabilities, and if we have a certain A by E, then risk will start coming down, and lower the leverage, risk will be lower. So this is the example given. Let's come to the example number 8. Should I make it full screen? Just 1 second. Yeah, here it is full screen. Foresight International Assurance is an international multi-line insurance conglomerate. It's an insurance conglomerate. Under its overall strategic financial plan, it computes the annualized standard deviation of the returns on investment assets at 5% and liabilities as 2.5%. So, SD of the assets 5%. Remember please, this 5 square will be multiplied with A by E square. My habit is I first multiply 5 with A by E, then do the whole square. It just saves me a moment. Similarly, 2.5 shall be multiplied by L by E and then the whole square. The bulk of the liabilities are constituted by NPV of expected claim amounts. Correlation between assets and liability return is therefore a very low of 0.25, correlation 0.25. Foresight's common equity to assets is 20%. So 1 by 0.2 is 5 times, sum over. So we know everything. So 5 multiplied by 5. 5 is the asset equity ratio and 5% is the SDF asset. 5 into 5 is 25. 25 square, 625. Then L by E becomes what? 4. So 4 into 2.5 is 10. 10 square, 100. So we have 625 plus 100, 725 minus 2 into 0.25 into 5 into 2.5. Let me show on the calci itself, otherwise people will feel that what is he doing. Okay, just 1 second. So we have 5, that's the asset equity ratio, multiplied by 5, that is the SD of assets. Sorry, what's happening? 5 multiplied by 5, 25, the whole square. Okay, square, STO1. Now, 4 is the liability to equity ratio, multiplied by SD of liability 2.5 equal to 10 square, STO2. Now, 2 into correlation 0.25 into SD of asset I'm doing it again. 2 into 0.25 into 5 into 2.5, correct? Equal to. Did I do A by E into L by E? I don't think I think I wrote the formula a bit wrong, as in the formula will be, the formula will also contain into A by E into L by E, na? Into A by E into L by E. Really sorry. So 2 into correlation into SD into A by E into L by E. So I need to do that over there. So I'm doing the third term again. So doing the third term again, 2 into 0.25 into 5 into 4 into 5 into 2.5. Let me hope that I am doing correct. So this is STO3. So RCL1 plus RCL2 minus RCL3 equal to square root. 24.49 is my SD coming to. Okay, I may have committed some mistake. Let me check. 24.49, then I am showing you it in a written manner. What was the first question? Once again. So the first question was, what is the SD of the change in the Foresight's shareholders' capitalization? So they were asking us sigma E. So the first answer here, 24.49, it's correct. Okay. So if you were copying the notes, please rectify the formula. The formula was SD of equity is equal to A by E the whole square into variance of asset plus L by E the whole square into variance of liability minus 2 into R into SD of asset into SD of liability into A by E into L by E, please. Okay, the correct formula. So what were the figures over here? The equity capitalization was 20%. So asset by equity was 1 by 0.25, 5 square into SD of asset was 5%, 5 square plus liability to equity was 4 square into SD of liability was 2.5, 2.5 square minus 2 into correlation was 0.25, SD of asset 5, SD of liability 2.5 into asset by equity 5 into liability by equity 4. And the answer came to, what was the answer? Just 1 second. 24.49. The answer came to 24.49%. Now I do not like that students decorate, write the formula, write the figures and then do the sum. Why do you have the calci then? Your command over the formula should be such that you don't have to touch the pen at all. And that happens only when you do it with numbers and you think with concept. Concept plus numbers, not the notations. I am against notations. Okay, concept plus numbers. So volatility of equity depends on volatility of assets scaled by A by E the whole square. Volatility liability into L by E whole square minus 2 into A by E into L by E into correlation into SD into SD. That's simple stuff. Okay. Theory wise, lower the SD of assets, better it is. Lower the SD of liability, better it is. Lower the leverage, better it is. Higher the correlation, better it is. So the bank's strategic posture has to be to reduce the volatility of equity by lowering sigma A, lowering sigma L, lowering A by E and increasing correlation. Sorry for sounding repetitive, but that's the crux. Okay. In terms of the equation, you should not forget about the crux. Let's see the second part of the question. So I'm looking at the second part of the question. Okay. Management believes the overall risk profile of the company is too high and desires to increase the common equity ratio by issuing additional shares. So they are decreasing the leverage by increasing equity and listing such shares on several international stock market exchanges. So liquidity will also be there. The new target equity ratio will be 25%. That is 4 times 1 by 0.25, 4 times. So 4 is A by E, 3 is L by E. All else equal, how does it impact the volatility of shareholders' equity? So I can do it on the calci, but once again, some of you don't seem to be comfortable. Okay, is what I'm sensing. I don't know. So if I do it directly on the calci this time, it's 4 A by E into 5. That was the SD of asset, 20 square. STO1. Now 3 is L by E into 2.5, that was SD of liability, equal to whole square STO2. Now we have third term, 2 into A by E was what? 4 into L by E is what? 3 into correlation is what? 0.25 into what is the SD of asset? 5 into what is the SD of liability? 2.5 equal to STO3. So we have RCL1 plus RCL2 minus RCL3 equal to 381.25 square root, 19.53%. And I'm damn sure it is correct. So 19.53% is the answer. Let's see. Yeah, 19.5%. Okay, 19.5% is the answer. Third question. Management believes it also needs to lower the volatility of assets. It shifts out of low quality bonds into higher quality bonds. That's what a sensible fixed income investor will do in the COVID environment. Shift from low quality to high quality. more liquid government securities, and by doing so expect to lower the standard deviation of asset to 4%. So SDF asset was 5, it becomes 4, without having any impact on the correlation between assets and liabilities. Beautiful. Along with stronger capital ratios premised in question 2, where the capital ratio has become 25%, so the A by E has gone to what? 4. What does this do to the volatility of shareholders' equity? Obviously, it will come down. Let's do it again. Sorry. So I'm doing it again. Just 1 second. Yeah. So I have 4 is A by E into the SD of asset is 4. So 16 square STO1. Now the second is L by E. No? So 3 into 2.5 was the SD of liability. 7.5 square STO2. Okay. The third term 2 into 4 A by E into 3 L by E into correlation 0.25 into SD of asset 4 into SD of liability 2.5 equal to 60 STO 3. So we have RCL 1 plus RCL 2 minus RCL 3 equal to 252.25 square root. 15.88%. SD of equity will come down to 15.88%. 15.88%, let's see. 15.9%. Perfect. Fourth question. What is the impact of various portfolios and capitalization changes on the value of foresight common shares outstanding? Value of the common shares outstanding. Explain your answer. What is the impact of the various portfolio and capitalization changes? They decided to shift the portfolio from low quality bonds to high quality and government bonds. So what will happen? Yield will come down, the return will come down, bank will be able to earn less, so the cash flows will come down. And equity capitalization changes. So equity capitalization, they increased it. Normally cost of equity is what? Higher. Okay. But then we can't say on the capital structure too much. So what is happening over here is that the bank's future cash flows will come down because of lower yield. But the risk of the bank is coming down, so the discount rate will go down. So number 1, cash flows will go down, so share price should fall. Number 2, firm is becoming less risky, so therefore it should attract a higher PE multiple, higher PB multiple. So you have a very difficult situation, lower return, lower risk. So the effect on equity cannot be said with certainty. So you have to argue and explain. Okay, you have to explain what? Since we are shifting from lower quality bonds to higher quality bonds, therefore yields are going to fall. So lower cash flows in future. Okay. Number 2, since our risk is falling, sigma E is falling down, therefore higher P ratio or lower discount rate to pull the cash flows. Net, the effect on equity cannot be said with certainty. Okay. The fourth question is a theory question. I am not reading it out. I am never accustomed to reading what is written over there because that is not my style. Okay. That means we are subservient to what is written over there. So we will follow the institute everywhere because that's how it will be tested in the exam. But we will not ditto, try to copy them and read them and all that stuff. In the exam, CFA Level 3, AM session, you do not get marks for language. You get marks for substance. So irrespective of how your English language is, so people, okay, in this part of the world, many of them are very, very good thinkers. Their mind is very bright. They can think properly, but they are not able to express in very elegant words. No issues. You write the substance, you get marks for it. They do not check you on the basis of the flow of the language. Okay, so your idea should be clear. So this was example number 8. Okay, and there are some mini cases. So what I'll do is that this is part 1 of my video on this portion, section 7.9. This was part 1. In this part 1, I've explained you all the equations, and the main thing that I've explained is that the risk of equity depends upon 4 things. Number 1, the risk of assets and liabilities. Lower the lower the risk of the equity. Number 2, on the leverage, lower the leverage, lower the risk of equity. And number 3, it depends upon correlation. Please match your assets with the liabilities. Whatever interest rate risk they have, your asset should have the same interest rate risk. Whatever credit risk the liability has, same credit risk of asset. Whatever convexity risk the liability has, same convexity risk of asset. Whatever credit risk your liability has, same credit risk of assets. If you match it, correlation will go up and equity risk will come down. That is the crux. Okay, how do you do it? Business decisions, yes, the CEO, CFO will do it. How do you do it? Portfolio decisions, yes, the investment portfolio manager will do it. That is the crux of this portion. But I will also put a part 2 of this video wherein I will do the mini cases with you. Okay, and I will also show you the Excel sheet. But I believe when I am discussing or showing you the Excel sheet in an open manner, you can anyways play with it. Now, this is CFA level 3, not CFA level 1. So people can easily tinker with the Excel sheet and see how that solid graph, okay, where the plane was there, how is it made and what's the effect it's happening on everything. Okay, so thank you. See you again in part 2 of this institutional IPS series. Thank you.